this session might be a bit short, so let me go straight to today's session. So calculating the intrinsic value using the DCF. Okay, so I am very sure this session I'm going to go over, it's quite tricky. Okay, so you point out your questions. I may not be able to go through all your answers today. So tomorrow, all right, tomorrow, just take today's session as a lecture. All right, tomorrow I'm going to take your questions so that we can all understand it properly. Today, because of time, I have to start work at 8:30. So I'll quickly go through, but pay attention. All right, the video will also be available for you. Pay attention, you can watch the video so that tomorrow, God willing, when we meet, then we'll have a fuller section from 7:30. I would like to focus this particular one. I must say, is a challenge for a lot of people. So let's pay attention and critically put down questions, and I will attempt to answer them for you. So let me move straight. All right. Jeffrey brought up a question yesterday, but I would like to also postpone that one for tomorrow. Okay. Today seems to be a bit very tight for me.
Okay, that's fine.
Yeah. Regarding the alpha, the beta, I'll go over them again. Saturday will be a fuller, like a longer session, like we did the previous weekend. I'll go through all that we have done, all the tricky parts. We'll go through all of those to enable us all appreciate what this is about. All right, so this is a simplified guide for non-finance students. I know there are a lot of finance students here, but I structured it in a way for everybody to understand. So even if you're a finance student, I know you are facing challenges. I'm not saying for sure, but I mean, some of you are facing challenges with the approach of how to go about this thing. But if you are facing challenges, this is a very opportune time for you to understand, to grasp everything. So for the non-finance students yourselves, it is a good opportunity for you. It's a session that you can understand how to value a company. Okay. All right, so we're going to go by the free cash flow to equity discounted. There are two approaches here. So the free cash flow, find the free cash flow, that is step one, and go ahead with the discounted cash flow, from which we'll derive our intrinsic value. It's the same approach we did with the Excel and with the GCB intrinsic value calculation. I'm trying to use the same data for the full lecture so that we don't get confused. All right, so what is FCFE? All right, it's cash available to shareholders. Understand, it's cash available to shareholders. For financial analysts, we are more interested in the cash. So we deal mostly with the cash flow of the business. So with the FCFE, we are trying to derive or to understand the cash flow position of the business. So free cash flow to equity represents the cash available to shareholders after all expenses, investments, and debt obligations have been paid. There's the formula. I think this formula I've been displaying it all through around. It's in the Young Investor calculator as well. This formula is a standard formula. Net income plus non-cash charges. You take out capital expenditure, then change in working capital, then you add back net borrowing. So we examine GCBs, that's what we've been doing, to calculate each component and determine the intrinsic value of the stocks. So with this formula, we are picking them item by item, or component by component, to understand where and how to get all of them. So with the net income, we know the source. It is the income statement. Income statement. When you pick the GCB financial statement 2021, this is the profit that was recorded. Okay, and even with the Excel that I shared with you, if you have access to it now, you open it. This is the data that we have in there. So 227 million, 305, 333, 423, And we all saw the rise between 2024 and 2025, about 90 something percent. So 423 to 843. That is the income position from year 1 to year 5, 2021 to 2025. Now, when you come to the non-cash charges, they are the costs that don't use cash. Costs that do not use cash, so like depreciation, is found in the income statement and the cash flow statement. All right, so these are the figures for depreciation. For our sake or for what we are doing, we are capturing the depreciation and amortization, and that is, you can get it from the cash flow statement as I shared with you. So from the figures, as you can see, 2021 to 2025, these are the figures. Check with the data that I shared with you. It's the exact thing that I've put in these slides. Component 3 and 4, so capital expenditure and the working capital. So with the capital expenditure, it is the purchase of property and the proceeds from the sale of properties. So capital expenditure. All right, so these are the figures as you can see. And the change in working capital, basically, it is the current assets minus the current liabilities. All right, this is a more simplified definition, but basically current asset minus current liabilities. And these are the figures also you can see. So from 2021, you pick them one by one. Then as you go to 2025. Tomorrow, I'll be picking from the statement I shared with you, and we compare to this so that you can follow through the discussion. And the component 5 is the net borrowing and the calculation for the free cash, the FCFE. Okay, the FCFE calculation. So with the net borrowing, you can see the figures there. So they are the loans minus the repayments, also found in the cash flow statement. So it's normally referred to as the changes in borrowings. Loans minus the repayments. So the net figure is what we put there. Positive values indicate more borrowing. Positive values indicate more borrowing. So this is the net borrowing figures as you can see. And we come to the resulting values for the FCFE. We're going to break it down and come out with these formulas. So I'm going to show the Excel also to you so that you know how come we came up with the FCFE values. All right, so year 1, it came up to 166. Year 2, it was a negative. Year 3, 1.2 billion. Year 4, 9.6. Year 5 is 2.1. So the average over the period is 608 million, as you can see on the screen. And from there, we'll zoom into the DCF. So this is the DCF formula. As I say here, you do not need to chew, as in to try to gather all this formula and put it in your head. You just have to understand the approach that we are using. So with this formula, we'll factor in the cost of equity, the free cash flow will come in, the terminal value. We'll apply all the components that we have discussed here. So the cost of equity, we explained yesterday, that is the return that shareholders expect. All right, so with that, the calculation is the CAPM approach, where we factor in the beta, the treasury bill rates, and the equity risk premium. That was fully explained in yesterday's session. Perpetual growth rates is normally the GDP, it's aligned with the GDP growth rate. So we said that the projection for Ghana GDP is 4%. So we decide to use you can use a more simplified approach, as in you can use a lower figure. Okay, so let's say 3.53. But in all this analysis, all you have to do is to do a sensitivity analysis to see how changes in these components, how they will impact your intrinsic value. The outstanding shares, they are sourced from the financial statement and AFXYC, as I showed you, I've been showing you in previous slides. Now, the discounting, when you're able to get your free cash flow to equity figures, then you have to bring them into present value. All right, we bring them into present value. So these are the present value of the free cash flow figures that you can see here. This is the sum of the present value of all the free cash flow. It's 1508873.01. I will not share the slides with you yet. I'll wait when tomorrow we get the full numbers as we normally get, then I will share with you, but the video will be online. Okay, so terminal value calculation. We project the step one is to project the FCFE for 2026. All right, so the last figure 2116 for 2025, we project it into 2026. So when you project it, we are using the rate of 15%, which has been assumed. So using 15% based on loan and future projections. If you check there's a bit of a fluctuation between the years, and if we overestimate, we may be getting too high figures. So to be on a conservative way, I decided to use a 15%, and that is what I've been using all through my calculation. So when you project the final cash flow figure of 2.1 into 2026, you are getting 2.4. Then you apply the terminal value, all right, with the assumption that it is going to grow at the same rate forever. All right. These are the steps. Okay, these are the steps. You have to know these steps. These steps there, you have to know them. Okay, as part of understanding why we are using them, you have to know the steps, because this is how we go about in calculating the intrinsic value. Okay, so what I'm saying is that after you are done with calculating the free cash flow for each year, the next step is to project for 2026. Okay, project for 2026. Then after you project for 2026 using the assumed rate, then you apply the terminal value formula. Okay, this is a terminal value formula, assumption that is going to grow forever at the terminal growth rate, whilst you are applying the cost of equity figure, that is 23.08. So that's what you can see there. With this approach, you don't, if you are using percentage, use percentage for all right, but for simplicity's sake, try and convert them into decimal. So you can see 23.08 is now 0.2308, terminal growth rate of 0.04 instead of 4%. Yeah, so, and yes, instead of 4%. If you use 4% in one breath and go and use percentage in another, you get a wrong figure. Right, so the terminal value for GCB is 11.5 billion. Then we discount it to present value. All right, discount to this one, you use the present value formula. So the future value over 1.2308, it is 1 plus 23%. Then you apply the growth rate of 5 as the is growing to year 5. So as this is growing, you assume that it's growing forever. You bring it back into present value terms. So bringing it back to present value terms will come to 4 billion. That is the figure we can see. So 4.01. So present value of the terminal value. Step 1, you project. Step 2, you apply the terminal value formula. Step 3, you discount it to present value. You discount the terminal value into present value. Okay. So when you are done with that, you have to sum the present value of the FCFE. You add it to the present value of the terminal value. So 1508. When you sum all the figures of the FCFE, okay, the total is not okay. So that's it. Present value of the sum of the present value of FCFE, it comes to 1508873.01. All right, these are the indicators on the right. You sum all of them to 1.5, then you add the present value of the terminal value, that is a 4.01. Okay, then it comes to 5.5 or 5.6. Okay, then that is your intrinsic value for GCV. That is your intrinsic value for GCV. If you are asked to do it per share, that's when you apply the outstanding shares to it, and you come to your 21.11. Then the conclusion will be as you are seeing on the screen. The potential and the valuation is 121%. All right, so you can conclude that GCB calculated intrinsic value suggests a significant undervaluation compared to its current market price, indicating a potential investment opportunity if our assumptions hold true. Okay, so these are some sensitivity analysis, but these are the main points as you can see. Let me quickly go through the Excel that I've been showing you every now and then. Okay. This is also a different approach. I've been telling you that in the last stock page competition, this is the Excel that we used. Okay. And with that one, with the calculating the free cash flow, you would only apply the capex to operating cash flow. That is the very easiest approach. All right. So operating cash flow is gotten from the income or the cash flow statement. Okay, the cash flow statement. When you go to the cash flow, so let's say cash flow E32, cash flow E32, E32. All right, so 1256025. So that's the same figure we have here, and it continues up to the end of 2025. So 2025 is 2891. 2025. So that's the figure you can see here. So these are what we use to calculate the free cash flow. So once you have these figures, you take out capital expenditure, and capital expenditure is as I explained, is the purchase of plants and equipment. So with this one, cash flow E36, you go to cash flow E36, scroll down 36. So purchase of property, equipment, and rights of use assets. So you pick those figures and come and put them here, and with that you're able to calculate the free cash flow. Okay, the free cash flow is operating cash flow minus the capex, and you apply the formula to all of them. So free cash flow as at 2025 is 2998844. Okay, don't worry, we'll go through everything again. Don't worry. Okay, then I try to get the growth of the free cash flow, as you can see. So with this, this is what we use to do the projection into 2026. Remember in the slides, I made mention that I chose to use 15% to be of the conservative type or side. But the thing is that if you are projecting into the future, it has to be based on what has happened in the past. If you are working or if you're analyzing a company that is very consistent with cash flow, with its operations, that things are smooth, then you can technically use what has happened in the past to project into the future. But see what is happening with GCB regarding the cash flow. In between year 1, year 2, it rose 43%, 0.11%, 175 drops to 41%. It's normal for banks. But do you say that you want to use this average? Right, this is the average growth. Do you want to use it to project into the future? It won't be realistic. So with that, we apply 15%, as you can see. So growing into the future, we apply these figures. And as I said, it is the same procedure, all right, in calculating for this the intrinsic value. All right, even though the structure looks different, we are applying the capex operating cash flow. The processes, they are the same. All right, so we find a discount factor, that is the cost of equity. So as you can see, the valuation assumptions are here. All right, and this is 55%. Let me change it to 23.08. Okay, 23.08%. Then when you apply those discount rates, then you find a present value of all the projections. So it's the same formula as you apply the discount rate to the cash flow figures that we have up here. So when you apply this, so it's going to be the free cash flow figure multiplied by the discount factor. Right? This is a discount factor, and it's gotten from the cost of equity figure. So as you can see, you find a discount factor here, then you apply the same formula to get the rest of the figures for the rest of the years. So 2026, 2027, up to 2029. All right, so as I mentioned, you find the terminal value. The terminal value is also the same approach. You apply the last year of the forecasted year, then you have to assume it's going to grow like forever. If it's going to grow forever, this is the figure that you're going to get, and it's coming from applying the cost of equity and the terminal value. Terminal value is a figure for the GDP growth rate. That's assuming that it's going to grow forever. But the cost of equity is what investors are expecting to get when they put their monies into the business. So you have to apply both rates to the last projected year figure. All right, when you do that, you're coming to 28.5. Then you discount this into the present value. So the discount factor is what we have here. That is 0.81 as calculated earlier on. So we bring it to present value terms coming to so when you are done with this, bringing it to present value, the next step is to add all the total free cash flow that's been discounted to today, present value of the future cash flow. You add all of it, then you add the discounted terminal value. As you can see, the discounted terminal value. Then you will get the present value of the FCF, total present value of the FCF. Okay, so that will be your intrinsic value in all. Then you apply your outstanding shares. So as I said, this one, it overestimates this approach. Even though it's correct, it overestimates the intrinsic value. And for now, I don't think I would want to recommend this Excel, but it works anyway. It works anyway. Some valuers use it. You can verify from anywhere. The formula is operating cash flow. You reduce it by the CapEx, then you get your free cash flow. But the formula that I am taking you through now takes into consideration non-cash charges, capital expenditure. You see, this one in the Excel doesn't take into consideration the non-cash charges. It doesn't take into consideration the change in working capital and the net borrowing. So what I'm saying is that sometimes it may overestimate your future cash flow. So even though this approach is correct, we would use the current one as we have gone through. I hope I'm not confusing anybody here. And this is the Excel that calculates or that takes into consideration the factors or the components that I'm talking about. So net income, non-cash charges, CapEx, change in working capital, and the net borrowing. For these ones, it attempts to calculate the free cash flow to what is supposed to be. So with this, you can see the years of the net income. So 2021 up to current 2025. And non-cash items, you pick all of them. CapEx, They are all stated in here. The change in working capital in the presentation, I made mention that for banks, change in working capital can actually be very volatile. It can be very volatile. So what I did was to add the first 3 years and find the average. Okay, so if you see on the screen, average is 573.94, and that is what I applied in the next 2 years. So I made mention, I think the last time, that for year 4, the working capital value came out to like 6 million, whilst year 5 came to like 2 million, and it didn't make it sent the intrinsic value into negative. So let's say 6 and 3, 2 million, and 3, okay. And that's not what we are looking at. And it's not expected that this trend is going to continue into the future. It's going to stabilize, going to normalize. So why do you want to apply these figures when you know as an analyst that this thing is not going to be continuous all through the years? So you have to apply your skill as an analyst, your understanding the industry. Okay. For all you can see, there are negatives in year 1, negative in year 3. And it is possible that in the year 6, or yes, it's possible in the year 6, the figures will start normalizing. Year 6, year 7, going forward, yes, things start normalizing. So you have to find a way to ensure. So for finance, we decide to average what has happened in the past and use it to normalize the years going forward. And the net borrowings too, these are the figures that we got from the net borrowings. Now you calculate the free cash flow for each year of these are a repetition of the figures as we can see here. 1.8 is 1.8 here, 227 is 227 here. So we calculate the free cash flow for each of them. All right, then is it so this free cash flow is what you can see on this page. Okay, so in 2026 or 2025, there's a free cash flow. All right, so we try to discount them into present value terms, and in putting them into present value terms, this is where it comes to. And is the total present value of the free cash flow 1.8. Okay, so terminal value, I think I explained the procedures are the same. So the terminal value is the figure, is the free cash flow, you add everything here. Then yes, so I mean these things they just populate. You once you have access to this for this Excel, it populates and it goes through the same processes as we can see. For the sake of rounding, some Excel sheets might have maybe some few differentials in intrinsic value. So you can have some 22, 23 somewhere. Some of these Excels, but they shouldn't have a very huge range or wide difference. All right. So if you're getting this in the region of 21, 22, 23, you are in a good range. You can call your intrinsic value. So this is the Excel for it. Let me try with the Young Investor calculator and see how it will come out. Intrinsic value, advanced FCFE calculator. Let me see. I haven't tried it on it yet. Let's see how it works. Okay, so let me see. You can just copy and paste them. Okay, non-cash. Copy and paste. Capex. Copy and paste. Change in working capital is a negative here. Copy and paste. Net following. Yeah, 2 net income. 6. Hope it works perfectly. All you need to do is to ensure your data is accurate. Now here 3. Oops. And then the final year. It's really tight today. So $23.08. The top profit is for valuation year to 265. 123. On the calculates. Okay, so here I think we are getting a lower value of 16.89. Okay, so there might be some differentials in some of the components, but the basic thing is that we can see that even with this approach, the free cash flow, I think maybe I might not have computed some of the figures.
Kofi,
Yes.
please, the perpetual growth rate, it was 4, but I think you mistakenly typed 3.
Okay.
And
I'm
then
sure.
the net something to, I think it was supposed to be negative, but you just inputted the
Okay.
figure.
Okay. I don't want us to go through it one by one, but I think the main point I want to stress here is that whatever approach that we use, GCB is wholly undervalued.
Oh,
It
okay.
is very undervalued. That's the point. You see, when I change the perpetual growth rate from 3 to 4, see, it comes to 16. When it comes to 4, as in the right one that we are using, it comes to 18. If I'm not careful, I have to go through the figures one, and Charlie, today time no share that day. So I beg you. Other than that, we have to emulate the same figures as we have in the Excel, and I'm sure we'll come very close to the 21.11 we are seeing there. But the main point is that GCP, as is listed on the GSC, it is undervalued by a huge percentage. Okay, so let me take some 5 minutes questions. Okay, 5 minutes, just 5 minutes, so that tomorrow we'll take our time and go through it. Tomorrow, I promise you, I won't be late. I won't have anything to cross me to attend to you. So let me take some 5 minutes questions. If there are questions, kindly ask them. If you want to keep them till tomorrow too, that is fine, so that we take our time to answer them. So this brings me to the end of today's presentation. Any questions, please? Any questions? Harry, is there any question? Jeffrey.
I think I have to go to it tomorrow. I'll come back with my questions.
Today's session there, it's too much
Yeah.
speed.
Yeah.
It's too much speed.
Thank you very much.
You're welcome. Jeffrey, any questions?
No, I think I'm still thinking about the questions, so probably I'll add it to the previous ones, then you answer them tomorrow.
Okay. All right, thank you. Kobe, Gio Kobe.
Yeah, hello.
Yes, Gio.
It's okay for today. Let's say tomorrow we'll see if there will be a question.
Okay.
Thank you.
All right, thank you very much. All right, so thanks to all of you. We'll meet again tomorrow. Raymond, are you there?
Yes, please. I'm here.
Right, that's good. I hope you are flowing. You are flowing through all the discussions. Okay, that's very good. All right, so let's meet again tomorrow. Fuller session so that we will understand. Okay. All right. Thank you. All right.
You're welcome.
Thank you, sir.
Thank you.
Hello, sir. Mr. Govi.